All right, guys, let's talk about a significant problem right now that the Fed, the economy, and the problem with money right now has really affected 100 million plus Americans right now. And this is the cost of everything. Okay. And we've seen interest rates do this, and we've seen the average everyday American become more like the average everyday poor American. And you look at the average everyday American dream, if you asked the average everyday person, it would be to own their own home as one of the main criteria. And the problem is you used to really think that $100,000 a year was a lot. It was the American dream. It was one of the criteria of the American dream to be pretty well off. Maybe even a lot of people would say wealthy. If you made $100,000 a year, you were pretty well off. Nowadays, it might not even qualify you for a home, an average home. Take a look at this. Okay, first of all, the average home in America is now over $400,000. It depends on where you are. In some places, you can't even get a home for $400,000. The median prices of homes sold in the US in the second quarter of 2023 was $390,500, down from $399,900 in the first quarter, and $417,800 in the fourth quarter of 2022. The median price was also $417,800. So for the average price we'll look at here is around $400,000 for a nice clean round number for people to look at. Historical trends show here in this graph shows how much prices have gone up. In 1985, the average price of a home was $100,000. In 1990, it was about $150,000. In 2000, it was about $200,000. And then it went up to about $300,000 in 2005. And then it went up to about 350 in 2015. And now we're up to over $400,000. Yeah. In fact, this chart shows that we may even be closer to $500,000 according to Fred. I think this may be Freddie Mac or so. But yeah, so we will just go to $400,000. When we go to a mortgage calculator here, you can go to Google and just go to mortgage calculator. When you put in $400,000 on a mortgage calculator here, the average interest rate here in Google automatically pops up as 7.5%, 7.568. So we would just go with the default interest rate of what Google shows the monthly payment of $2,816 with no anything else included. That's no property taxes, that's no electric bills, that's no car payment, that's no anything else. That's just the mortgage payment on a 30-year fixed mortgage, okay? And if we bust out a calculator really quickly here, 2816 times 12 monthly payments is almost $34,000 a year. In fact, it wasn't that long ago that a person making $34,000 was not that bad. Now, that's a third of $100,000. In fact, if you Google what should your earning be, what should the percentage of your mortgage be? The 28% mortgage rule states that you should spend 28% less of your monthly gross income on your mortgage payment. Okay? So if we just look at this here, we do actually not qualify here because if we're looking at it here, if we had $100,000 income, This would be 34% of our income. Banks want 28% here based on the 28% mortgage rule. What percentage of your income should go to a mortgage based on Chase Bank? And we do not qualify under the 28% mortgage rule. Now, I'm sure banks have other rules that can get you to qualify, but based on the old golden rule, uh, eh, don't qualify. Okay. Now, what that means is that, and of course, this is all due to the interest rate. If we go back a few years when you could get 3% interest rates, let me show you the difference here and how much the interest rate qualifies here for. 7.5% interest rate at the same home at $400,000 is $2,800 for round numbers at 7.5%. Let's change this same home, $400,000 to 3%. Watch this $2,800. Watch what this is going to do. Ready? 3%. Look at this. It went from $2,800 to $1,686. We'll call it $1,700. It went down $1,100 a month, guys, just because of the interest rate. So that means $1,100 more per month going to interest just because the interest rate is 7.5% instead of 3%. So that means the banks are getting $1,100 more per month in interest just because the interest rate went from 7.56% to 3%. And remember, it was only a few years ago that interest rates were 3%. Here's the other thing you got to factor in to this $34,000 a year that is being paid to the home, okay? Is the average property tax rate for all 50 states is 1.1% or about $4,000 per year, 3,909. Remember, we're dealing with round numbers here because everybody's going to have different numbers here. So we'll round this to $4,000. So this $34,000 here, $34,000 plus $4,000 in property taxes is $38,000. This is before you have any electricity. I don't know, what is that? You know, $2,000 a year. You're at $40,000 a year. And then you're going to have house insurance. I don't know. We'll be at $41,000 a year. We'll be generous here. And then you're going to have things like home repairs that could easily be, another $1,000 a year. Again, some years you might have nothing, some years you might have something. So again, you just add in an average cost. And then you're going to have other expenses like your car payment, right? Car payment. Almost everybody has a car payment, right? And again, the average family with a mom and a dad may have two car payments. So we'll give you the benefit of the doubt and say you only have one car payment, right? But when you look here, what is the average car payment? Okay. The average new car payment, if you go to buy a new car, is $726 a month. That's if you buy a new car. Remember this $42,000 a year. If you go buy a new car right now, just one new car, times 12 is almost $9,000 a year just for one new car. If you go buy one used car, and a lot of this is because of interest rates and car prices going up every year. Remember, the United Auto Workers just got that big raise, which is also going to help car prices go up. The average price of a used car is $533 a month. So again, even if you have only one used car times 12, that's $6,000 a year. We'll round down, okay? So what were we at? $42,000 a year plus 533, that's per month. So 533 times 12 is $6,000. $6,000 plus the $42,000, $50,000 a year that we're paying here just on our home and a car, right? So you can see the problem here on how people can't even qualify for mortgages, right? They can't even qualify for mortgages. And this doesn't even account for credit card debt. Credit card debt just smashed another record high at the end of 2023. While delinquencies are also on the rise as well, credit card interest rates at the highest they have ever been as well. Now, when the Fed starts lowering interest rates, we'll see interest rates creep down a little bit. But the problem is that home prices might start going up then. Because what will happen is we'll start to see people rush into the market to buy homes because they see that interest rates are coming down, and then home prices will start going up because there'll be more buyers trying to buy the already small amount of homes that are out there, because so many homes, as soon as they go up for sale, they're gone immediately. So we already have a home shortage, and the problem, it repeats itself. So the problem here is that you can't, you're supposed to be under this 28% rule, 30% rule, because again, when you're spending 30% of your income just on a home, remember, home is just one expense. You have electricity, you have food, you have children, you have car payments, you have maybe student loans, you have credit cards. Even if you don't have credit cards, you have all these other things to pay for in life. There's a lot of other things to pay for in life: health insurance, medical bills, any other thing, saving for retirement. Please save for retirement, because 50% of Americans work their whole lives and don't save anything for retirement. So you see the quandary here of why it's so hard right now. So hopefully interest rates come down here over the next couple years, and we get back to those ultra low interest rates, and we don't pay an extra $1,000 a month on the average mortgage. The problem we will probably see then is that home prices will be sky high, as if they're already not sky high now. Imagine how high they could be then. And the other problem is the shortage of homes that there is, because as soon as homes go for sale, they're gone. And this is just homes. So yeah, the $100,000 mark, making $100,000 a year, that used to be like, hey, you were wealthy. That's not now more like middle class or even lower middle class. So let me know your thoughts here in the comments. Yeah, this is something I'm starting to notice. And I'll keep you up to date here with everything happening here on a daily basis. Please like and share this video, and I will keep you up to date here. If you haven't yet, subscribe down below. Click the bell icon so you don't miss out on new videos. Click here to see employers now beginning mass firings, or click here to watch my newest video next. Thanks, and I'll see you in the next video.